discussion on setting the context, state of the economy and the role of banking and financial sector, for which I would like to invite the moderator of the session, Ms. Rumki Mazumdar, economist, Deloitte India, and the elite panel joining her on the days are Sri Dharmakirti Joshi, Chief Economist, CRISIL, Sri Madan Sabnavis, Chief Economist, Bank of Baroda, Sri Saugata Bhattacharya, Executive Vice President and Chief Economist, Axis Bank, Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor, State Bank of India. Kindly take your seats on the dais, panelists, and over to you, Ms. Mazumdar.
Good evening, everyone. Welcome to the first panel discussion of the day. I'm Rumki Mazumdar. I'm economist with Deloitte India. And today we are going to speak, the first session is about the state of the economy and the role of banks and financial institutions. Now, over the past 3 years, the world has seen overlapping and unique crises one after the other, so much so that one can probably bifurcate the 21st century into a pre-2020 and a post-2020 era. Now, if you look at the seasonally adjusted GDP curve, it kind of trends smoothly up till 2020 and looks like a roller coaster ride thereafter. Now, I'm confident that economy will bounce back and this modulation will smoothen out. But my concern is that this undulation that we are seeing in the GDP curve might persist longer thanks to the global exigencies that we are observing. Now, on this issue, we have with us eminent panelists and economists who will weigh in their outlook of the economy as well as share their views on how banks can play an important role in driving economic growth. Let me quickly introduce them. I mean, they really don't need any introduction, but just will follow the process. To my left, we have Dharmakirti Joshi, who's fondly known as DK. He's the chief economist at CRISIL in S&P Global Company. Next, we have Madan Sabnavis, a corporate economist for 36 years, and he's the chief economist with Bank of Baroda. We have then Saugata Bhattacharya. He's the executive VP and chief economist of Axis Bank. And last and not least, Soumya Kanti Ghosh. He's currently the Group Chief Economic Advisor, State Bank of India. Welcome all of you to the panel's discussion. We have divided this session into two themes. The first will be mostly on the economic outlook, and that will be followed by the role of banks. I'll have one distinct question to all of you, but others, please feel free to jump in case if you have any views to share. Let me start with DK. So over the last 6 months, we have seen IMF revising up the growth for US, many countries in Europe, as well as even China. On the other hand, India's economic outlook, they have revised it down from 6.1 to 5.9%. I would like to know, what is your assessment of the economy, where our US, Europe, and China are heading, and what are the challenges that could impact the Indian economy?
Thank you. I would like to thank the IMC for providing me this opportunity. So I think as far as the global economy is concerned, it's expected to slow down in 2023. That's almost all forecasts point towards that. And S&P's outlook is it will slow down to 2.7% from... And S&P's assessment is that it will slow down to 2.7% from 3.4% last year. Now, I think the important part is that not everybody is slowing down. So there is a growth rotation taking place. US, Europe, they are bound to slow down, and I'll come to the reasons behind that. Whereas countries like China will show a rebound in growth, and India, I think, is somewhere in between. With 6%, it will still be one of the fastest growing economies. So US is facing a classic overheating problem, and the central bank is trying to slow the economy by raising interest rates. The issue is it's not visible. I mean, the impact of rate hikes is not visible in the economy. But what is extremely clear is that the high inflation that is persistent there has already eaten into the purchasing power to some extent. I think the counterfactual would have been US would be growing much faster than what it is growing right now. And now I think the impact of rate hikes will seep in. So I think S&P, for instance, expects the US economy to grow at 0.7%, which is a slowdown from last year. Europe is far more complicated story. Europe is not energy independent like United States. So it is dependent more on geopolitical issues, which have somehow been, the weather has been favorable. So Europe somehow managed to grow last year. Now I think it's expected to slow to 0.3% because rate hikes will also have an impact, and geopolitics is, we don't know. China's case is unique. I mean, so I think Milton Friedman, who's known more for monetary economics, had coined a term called plucking effect, which has nothing to do with monetary policy. It's about the rebound in the economy. So if you pull the string of a guitar down, then it goes up. So China had kept the string of the guitar down for long through its COVID policies. Now I think it's releasing that, so China is seeing that plucking effect in 2023. Now the issue is that this global slowdown and the growth rotation, more importantly, what does it mean for India? I think this is not favorable for India for two reasons. One, I think our exports largely go to US and Europe. About 35% of the exports go there, and they are the ones which are slowing down. And China is picking up, but our exports to China are only 4 or 5%. So it doesn't help us. So on a net basis, this global growth rotation is negative for us. Exports actually have already slowed down. I mean, if you take petroleum products out, there was hardly any growth in exports even in 22-23. The situation is going to be a little tougher there. Despite some cushion from services, etc., I think it's a negative drift to us. So I think not every country is losing from this growth rotation. I think Australia will gain massively because Australia has exports to China are 4 times that to US. So it's a very interesting growth dynamics that is playing out right now. And I think India, apart from some impact of global factors, will bear the brunt of the rate hikes that have taken place. I think they will moderate the economy a little bit. And oil prices still continue to remain high, so that's not a good scenario for us. Despite we buying some oil from Russia, etc., I think the crude and commodity prices are not in a favorable zone for us. So that's why we are visualizing growth decline from 7% to 6%. So that's, I think, and then there are many risks lurking around in the global economy. As the IMF had pointed out, the growth 2.7% or 2.8% looks good, but underlying that growth, I think there is a lot of turbulence which can show up anytime. And I think just 2 points before I stop. One is that the debt levels globally are very high. I think about 350% of GDP is the global leverage, which is 25% higher than it was during the global financial crisis. So when you have high debt, your interest rates are rising very sharply, and incomes are going to fall because GDP is going to slow down, then servicing the debt becomes a problem. So we have seen one set of minor accidents which are related to interest rate hikes. Of course, I think the collapse of the Silicon Valley Bank, which was mark-to-market issue, and similarly, I think the other banks which are also exposed. We haven't as yet seen consumers not being able to pay their debt back. So that is something that you need to watch out for. So there's a lot of stress which is playing out globally. Who knows how it will play out? Nobody can predict the financial accident. But yeah, the scenario is quite risky, and I think for India, I think in some sense we are in some sort of a safe zone, I would say, because our current account deficit is low, growth is high. So I think it kind of puts us in a better macroeconomic scenario, despite the slowdown that is expected.
Thank you so much, DK. And I understand that India will have to navigate through in order to have a sustainable growth at 6.5%. And if it wants to achieve a $5 trillion economy by the end of this decade, or $10 trillion economy by the next decade, it will have to depend a lot on the policymakers, because they will be providing the thrust. The challenge is that the policy prescription requires a right diagnostics of the economy. And with the current challenges that we are seeing, there's so much of uncertainty that it's very difficult to prescribe a right policy. Now, Soumya, I would like to bring you in. You are an economist with a bank, and it is very important to understand the economic theories in order to analyze or predict and even prescribe policies. Over the last 10 years, we have seen circumstances where policymakers had to take unconventional measures which were not backed by theories. From your view, what are the relevance of economic theory today when you provide policy guidance?
Yeah, thank you for inviting me to this platform. I think, Rumki, there is an interesting dynamics playing out. Yes, there is a large textbook. I will not make it analytical, but just to break down, there's a large textbook of macroeconomic theory, but I think there has been a lot of flask also in the last decades. If I give an example, I think all of us talk about wage price nexus whenever an economist talks. But when an organized labor market activity has actually broken down from the 70s, I mean, there is no trade union, for example, in India right now, if I look into, I think I'm not sure how much of that relevance is today, even though, I mean, there are some elements of linkage to it. Similar is the impact of, whenever you will see an open and paper, you will see the impact of crowding out, if there is limited resources. But I don't know if there is a demand constant economy, whether the theory of crowding out actually holds, because there is no demand for funds. So, and the most importantly is that the central banks across the world from 2008 has been trying to push up inflation. There has been several theories. It was stuck at 2%. When it came, generations of US has not seen this type of inflation, and this was central bank of, I mean, the Fed was actually not anticipating it. They did not anticipate it, and when they anticipated it and tried to hack, they were already lagging behind. And we are seeing now today happen, although the inflation rate has significantly declined yesterday's reading. In the Indian context also, I think the best part of the Indian, I mean, if I take the terms of, and make it short in terms of the policy prescription, I think we have done a very apt monetary and fiscal policy coordination during the pandemic, and the central bank, the Reserve Bank, actually had taken unconventional measures which was never, I mean, thought of earlier, because the Reserve Bank in its capacity is, there's only one tool, interest rate, but it actually used unconventional tools. It was forward looking, and it went ahead of the curve, which possibly I can make it, I mean, I can say it openly that I think the Reserve Bank was much ahead of the curve of the developed economy counterparts also, if I look into the examples of Fed and others. So policy making is very difficult, but at the end of the day, what is important that you should have an, instead of the monetary and fiscal policy, and much of the theories, for example, DK was also talking about this global economic slowdown, and initially all of us at the beginning of the year were projecting a current account deficit of more than 4%. Today we are projecting it less than 3%, next year projecting it closer to 1.5%, because there has been a revolution in service exports this year. Exports of goods and services, even in a world where growth is contracting, has expanded by close to 770 billion. So these are some numbers which we need to look into, and our exports have actually now becoming more macro agnostic, because we are also now exporting high skill exports and agricultural exports, which basically doesn't. So all in all, I think when you make policies, it's important that you look into the emerging trends, because what used to happen earlier, and even once in 100 years, that even now is happening once in every year. 2020 we had the pandemic, 2021 it continued, 2022 we had the war, 2008 we had the global financial crisis, 2001 we had the dot-com, and 94, 95 I think we had the Russian crisis. So I think every year we have a crisis, and so therefore our policy response has to be nuanced and real time. So, and that is actually the most challenges which the central banks and also the governments are facing across the world today. Right.
Thank you, Soumya. And I agree. this time the crisis that we faced were quite, had no precedence as such, and that's why they had to go about innovating measures to deal with it. But given the uncertainty, there's one thing that you mentioned is the crisis of the inflation challenge, which has been quite persistent. If you look at inflation in India, which started from 2020 and has been pretty much above the, in the upper band of the RBS target range. So, Madan, I would like to ask you is, where do you see prices going? And from the world perspective, even the world, as Homo said, that US, Europe saw inflation going 40-year level high. And even India is having difficulty in controlling prices despite the rate hikes. What are your views on it?
Yeah, I'd first like to thank IMC for inviting me here. So, Mr. Basu, thanks. Now, the thing is, when we talk of inflation, I think we should remember one thing, that when we say inflation is coming down, it doesn't mean prices are coming down. So I think that's a misnomer. Very often we are thrilled at the fact that 6% has become 5%. But actually, if you go to a housewife and say inflation has come down, she'll say you people are idiots, yeah, right? Because prices are going up by 5% still. So I think when we're looking at inflation number, it's more a case of saying that it's a kind of a policy target. That's why it's important whether it's 6% or 5% or 4%. Okay, let's have that clear. Now, let's look at prices. Now, if I go by what the World Bank has been saying, I think they are expecting that prices will remain largely stable. They could be moving down in certain cases. But it's been mentioned that the levels will probably still be higher than what it was in the pre-pandemic times. Now, why is this so? Why is this a very optimistic view? Because the moment we say that the world economy is slowing down, we're talking of recessions, that's negative growth, maybe Germany, UK, then there's obviously less demand for goods and services. So that's the reason why your inflation numbers, your prices are going to probably remain stable or come down. So that's very good news because of a global slowdown. I think that's a kind of an accompaniment which comes that the prices also slow down, so it's good news for everyone. What are the risk factors out here? Now, I think one thing is that if the slowdown in America is not as slow as what is expected, number one. Number two, in case China rebounds faster than what's expected. We all know that when China rebounds or it slows down, it has a major impact on all commodity prices. So today, if you're saying that these two factors sort of change, then we could see once again prices rebound. But chances are that when the World Bank has made these projections, they have probably kept all this at the back of the mind, and therefore we can expect global prices to remain where they are. Now, El Nino is another new factor which has come in. It is a development which is supposed to be fairly severe. Now, how severe is it for other countries, how severe it's for India is a different kind of an issue. I think everybody has their own view. We have seen what the IMD says, what SkyMet says are quite different. So I think if I want to make people scared, I'll say, look, El Nino is coming, everything's going to go haywire. If I want to comfort, I'll say, look, even in the past when El Nino happened, nothing really happened out here. Maybe inflation was only 3%, 4%. Maybe your tur dal prices went up by 50%, but my headline inflation number was 5%. So we're quite comfortable with that kind of thing. So the important thing is that El Nino is going to be a challenge because in case it impacts global commodity prices, agricultural prices, then to the extent that global trade takes place in agricultural commodities, there could be a case of imported inflation increasing across the world. But as of today, I think when we start off the year, I think the monsoon in India starts from June onwards. And we have seen that the pattern has changed over the last maybe 5-7 years, where the monsoon never starts on June 1st. It starts in probably July. It's supposed to exit in September, but it never exits in September. We always say that a prolonged monsoon has damaged the crop. So it's October, November before the monsoon says bye-bye to India. Now, the reason why this is important is that we normally look at the monsoon numbers and say that good monsoon means good kharif crop means stable prices. And in case it doesn't happen, inflation is of course going to increase, prices are going to go up. Now, what is really important for India, I think which even the RBI is cognizant of, is that the 96-95% of normal monsoon is not as pertinent as the arrival and the departure of the monsoon, as well as the geographical spread. Because we have seen that if the monsoon comes in late, the sowing pattern changes. So if I'm a rice farmer, I will not grow rice. I may change over to millets because I require a lot of precipitation, I require lots of rainfall. And if I'm in the rain shadow area, the Deccan Plateau area, the idea changes. So why am I talking about this agriculture part? Because when you're talking of inflation in India, while we are all quite confident that the 6% number will not happen again, But we feel that at Bank of Baroda, we feel 5.5% is a reasonable inflation number. I think the RBI is also looking at a similar number. And I think most of we economists, we have adaptive expectations. So tomorrow, if the inflation comes at 3% for some reason, all of us will say 5 has come down to 3 or 4. I think that's the problem you have to live with, economists. We always tend to adapt to whatever happens. Okay? Too low numbers, all of us bring it down. Too high numbers, and all of us scale it up. I think that's the problem which is there. So as far as India is concerned, let's go by the headline number, 5.5%. That is something which will probably prevail, which means stable inflation environment. Risk factor, of course, is on the agriculture side. Now, what I've noticed is that if you see the commentaries of a large number of corporates, which have brought out the results in Q4, also in Q3, lots of them have said we are still in the process of passing on the higher input costs. So what does this mean? The so-called core inflation, that is non-food, non-fuel inflation, is something which has the potential to increase in case companies have not completed this particular course action. So my sense is that probably for another quarter, that is Q1 of fiscal 24, we could still see some kind of a pressure on core inflation prices. I'm not quite sure how the core inflation number may still be acceptable at 5.5–6%, but definitely when you go to the marketplace, we may be paying higher prices for a toothpaste or maybe a smaller packet of biscuits. In fact, I saw the Crack Jack biscuits kept behind. The size has become much smaller. I suppose the cost has been kept at 5–10 rupees. We may see a bit more jugglery taking place out there. But prices in general, we could expect to be stable. The other risk factor, which I think probably is not being counted by lots of us, is the crude oil price, because we all started off as saying $90 per barrel. Now we're saying 80 to 90. Presently, it's in the region of 75 to 80. Here also, I think our expectations are adaptive. So tomorrow we see some shock in Ukraine or some OPEC does something, goes to 100, all of us will jump and say 120. We're going to be careful of 120. But as of today, I think we're looking at 80, 90. So on the whole, in short, I would say stable inflation, stable prices globally, stable inflation in India is what we could expect. So I think this gives a lot of strength for the Reserve Bank or for central banks across the world to take their monetary policy decisions, especially when we're talking in terms of rolling back of interest rates.
That is very comforting to hear that inflation is likely to be stable. The other challenge that India has been lately facing is that of the balance of payment issue and also the impact on currency. So Shomo was mentioning that services trade has changed, has picked up very strongly, but imports have also increased much faster, and total exports may not grow as much. So there's one trade deficit that we are seeing. Capital account is more or less getting stabilized, but not picking up yet. Where do you see the balance of payment heading, and also the impact on INR? Of course, we have seen INR depreciate by almost 11% in a year's time. Of course, large part of it is because the dollar itself appreciated. But since September, dollar has actually lost a lot of value, but INR has not gone back to the 70s that we had last year. It was 74 per dollar, right? So where do you see the balance of payment situation and the value of currency over the next 2 years going?
So let me join my fellow panelists in first thanking IMC for this opportunity to be here in front of this distinguished audience. So the balance of payments, actually, as Shomo mentioned, this was one area where we had a very pleasant surprise. So we began the year after the Ukraine crisis at about 4% of GDP. Shomo says 3%. I have a feeling it will come in close to this year, FY23, last year, I mean. So closer to 2% than 3%. So 2.2% is our current forecast. Next year, this year, FY24, it's likely to be below 2%. We need a balance of payments, a current account deficit, because we need capital from outside. Look at the components first. So merchandise trade. So first, we have been exporting, despite the slowdown in Europe, the US, etc. Our exports to both the US and Europe have been very, very strong. Europe, we know, we have been exporting diesel, ATF, aviation turbine fuel, and other petrol products to Europe, as if these products were going out of fashion. I mean, absolutely head-on increases and we are getting cheap Russian oil and exporting high cost to Europe. So that's one. Engineering goods in manufacture to the US have also been very, very strong. Steel products, fabricated products, etc. And electronics, we are beginning to import more. as Shomo mentioned, as you mentioned, I mean, the real surprise has been services. So we all of us know that India has been a major power in IT services, the back office to the world. In the last decade or so, we had actually gradually crept up into the mid-office segment, the analytics, MIS, risk, etc. So we've been moving there. Now, increasingly, we are moving into the front offices of the global value chains. I mean, you know, I mean, all of us know that data centers are mushrooming everywhere. All of us know that the global capability centers, the GCCs, this is what has been driving services growth. So, I mean, quite apart from this, now we are designing as part of the US conglomerates, the Qualcomms, the Broadcoms, 80,000 engineers in India are designing very high-end semiconductor chips. So, I mean, R&D is becoming more and more, AI, ML. So all of these things, and on top of that, we are increasingly now integrating into the global value chains, the China plus one story. Looking forward to next year, some things will happen. So one, export growth is going to slow down because a large part of these the export growth that we had, the $427 billion unprecedented, that manufacturing exports that we had exported, it was part due to commodities, and prices have come down. Despite the China reopening, we have not seen an increase in the basic metals prices, the copper, aluminum, steel, etc. We haven't seen. So that is going to pull some part of it down, so merchandise goods. On the other hand, counteracting this, a large part of our imports, other than the very high-priced oil before we started importing more Russian oil, had been imports of fertilizer, coal, etc. So now those prices have come down, so our import costs are likely to be lower. So that's one. So the balance of payments deficit from a negative last year will probably be somewhere in the $15 to $20 billion surplus, which will also aid the Reserve Bank of India in replenishing the forex reserve, which have already gone up significantly. And this has a bearing on the second question, on the currency, on the rupee. So as you mentioned, the potential slide, the Reserve Bank held through currency operations, held the levels. This, I think, we are going to have a much better year in FY24. We have already seen tendency for the rupee to appreciate. Right now, I think, so look, there are three factors largely which influence the currency, which influence the rupee. One are these flows, the balance of payments, the total flows. The second is the dollar. So if the dollar gains strength, all the emerging market currencies, including India, come down. The third is the Chinese yuan, the RMB. So the Chinese yuan still remains a threat because China is still printing money, credit growth is very high, all of that is still, and so the increase in the supply of Chinese money is likely to pull the RMB down. So that's a downward pressure on the currency. But given the fact that the Fed is probably has peaked in its interest rates, whether the Bank of England, the European central banks still have a ways to go. So that will keep the dollar down. So dollar is not going to strengthen too much. Although it's going to change, it's not going to strengthen too much. So of the third part, if you have a $20 billion BOP surplus, so all of these would indicate that the rupee is likely to be under far less stress, probably even to appreciate in FY24.
That's great to hear. We'll move to the next theme, but before that, maybe we can take one question from the audience on the economic outlook in case we have missed out on some issues. Only one, so I'll go with the person who first raised the hand. So
Rather particularly, I'm quite glad to hear about the rupee might strengthen also. My question is related to exports because our Piyush Goyal, our Commerce and Industry Minister, has said that maybe it will go to $2 trillion by 2030. So how is it going to pan out? Because we are already in 2023. So I'm asking a little longish term, between 2023 to 2030, how is it going to pan out? 2 trillion are we going to really achieve?
So keeping it very brief, so this is probably one of the key drivers that the government, and Piyush Saab, is a dynamic person, dynamic individual. So he's pushing for a $500 billion merchandise export target in FY24. Might be difficult, but our GDP is now $3.5 trillion in FY23. So going, as Rumki also mentioned, arithmetically it's completely possible. So the rule of thumb that something doubles 2x if it doubles, meaning, I mean, if something is growing at 10% or so, it doubles in 7 years. That's the rule of thumb. So we can grow at 10%, 6.5% real growth, 4.5% inflation. If we are lucky, we can actually see an appreciation of the rupee, which will pull the thing down. So 3.5 to 7 trillion by 2030 is eminently doable. If a part of that is exports, but exports is not completely in our hands. It's also part of the global economy, global system. The really interesting thing as of this point in time is our services, the strength of our services exports, which I expect to continue. So you will hear in the next panel the way that we are developing in terms of technological capabilities, the digital public infrastructure that we have developed. So all of that, but together with this, I think we are seeing increasing signs that India is becoming a large part of the global MNCs, the MNC environment, as a viable alternative to the China plus one. I know, I mean, you know, Vietnam, Thailand, etc., Indonesia, they're still very important, but India is emerging as more and more of a viable alternative in terms of an investment destination. And that's what I think it makes it feasible. Difficult, challenging, but possible.
Thank you, Shogoto. Anyone else who would like to weigh on?
See, actually, I'd like to raise a kind of red flag, because I think when we talk of $2 trillion, it's an aspiration. Okay, just like how we talk of 5 trillion economy, then 7, 10, what's the basis of it? Nobody knows. At some point of time, we'll become a 10 trillion economy. Probably even Bangladesh at some point in time, after 20, 30 years, will become a 10 trillion economy. So we should not get carried away by these numbers. Now, if you look at intrinsically, if you look at your exports, I think has been mentioned by someone, I forget who, our exports actually declined if you remove the petroleum products. So when the global economy slows down, to think that our exports are going to push forward, for the last 10, 15 years, we've been giving different numbers for our exports. Unfortunately, our exports have not been up to the mark. Now, today we're talking of services. I think services have done very well in the last couple of years, that's all. Now, we are extrapolating it, saying that when the global economy has slowed down this year, we all felt that the services exports will actually decline, but they increased. Now, to extrapolate to say that it's going to happen continuously, it's a lot of optimism. I'm sure we need to be optimistic. People in industry have to be optimistic. But I think we have to be a bit cautious in terms of interpreting it in terms of achievement by a certain date.
Rebutting the rebuttal, the other important part are the FTAs that we are signing. The UAE FTA is an incredibly important one. Yeah, so unlike Australia is not that important, but if now in the next couple of years we do FTAs, CPECs, etc., with Europe, with the US, with Canada, etc., keep note of that. That's another.
DK, I suppose you also want to have a...
Yeah, I think I'm quite passionate about exports, so let me... So I think very briefly, see, if you look at since you mentioned the export policy, if you look at the projections underlying, the merchandise exports, where we are talking about Make in India, PLI, everything, they are supposed to grow at 10% to achieve that target. The entire 2 trillion target is hinging on services exports. Services exports are expected to grow at 15% per annum. Service exports were 30% of total exports in 2012. Today they are about 42%, and they are expected to go to 50%. So this is not manufacturing which is going to fire exports, even with the government's own assumptions. The second thing is, I think this trend is, we have a lot of advantages in terms of China plus one, etc. But the geopolitics is a double-edged sword. I mean, on one hand, you are getting companies interested in India, but at the same time, there are protectionist measures also coming in. I mean, you can't ignore them. The Europeans are going to levy taxes border taxes on your carbon emission-related production. That's coming pretty soon. US has Inflation Act. That's an industrial policy. I mean, it's a protectionist industrial policy. So I think, on one hand, you will have some manufacturers move. On the other hand, you'll also have some headwinds. Now, coming to how much I think you can grow your exports, I think only time will tell. I think we still have competitiveness issues, but the way we have started, I think, is good. Electronics is gaining a lot of traction right now, and we are starting from assembly. So what's happening because of electronics? We are importing from China, assembling it, and then so our exports to US will look good, but our imports from China will expand. So So you're increasing your trade deficit with China and reducing your trade deficit with US. So I think there are many nuances. It's a very fluid situation. How it plays out, we'll learn. I mean, and we'll also change our views.
Thank you so much. Looks like the growth driver, which contributes 20% of the GDP, has hijacked the whole conversation. So let's move to the next theme, which is the banking, which contributes to the 100% of the economy growth. Over the last 1 year, we have seen Fed doubling down on its effort to contain inflation, and it has increased its policy rates from 0.25 to 5.25. 5% interest rate hike in just a year. And inflation, although has come down from 9.8 to 5%, but still it's 3% above the target rate. So, DK, my question to you is, like everyone is asking, what do you think Fed will do going forward? Will it take a breather, or will it continue aggressively? And what would have its impact on the RBI's decision going forward?
Well, I think I think even if you ask the Fed, they would not know what they're going to do.
True.
I think, that apart, I think our economists in US believes that the rate hike cycle in US is over for several reasons. One, I think the inflation is coming down faster than it is coming down in Europe. Second, I think it's still worrisome. I mean, and they don't see inflation come down very sharply anytime soon. But the monetary policy impacts with a lag, so some of that lag is going to play out towards the end of 23. The issue is not whether they will raise interest rates or not. The issue is how and when they will start cutting rates. There, I think it's higher for longer. What might play out. Even US, where inflation is lower than Europe and UK, will keep the Fed rate at close to 4% even towards the end of 24. That is the S&P's projection. So which means that rates, unless there is a financial accident. Now coming to Europe and UK, I think UK inflation is 10%, Europe inflation is close to 7%, and their core inflation, which they very passionately target or look at, I think is closer to 6%, between 5.5% to 6%. So in that scenario, I think they might still have to raise rates. Now, what it means for India, it doesn't mean that it will proportionately spill over to us. US has raised rates by 500 basis points. We have only raised by 250 basis points. But I think there's an important thing here that needs to be kept in mind. US is raising 500 basis from 0 to 5. We are raising from 5 to maybe 6.5 or whatever it is. I mean, yeah. So the impact in US is far, far greater than it's in India. I mean, they're starting from 0 base. They've raised it 5x. I mean, so now, as I said, our domestic inflation situation is quite surprisingly different from what the Western economies are facing. So my sense is that at least in India, the rate cycle has peaked. And now I think we will not see the further rate hikes, and inflation is going to come out today. The average projection is that it will be 4.8%, and which is because of the base effect also. Remember, don't forget that you had Russia-Ukraine conflict impact on commodity prices during the same time last year. So the base effect is driving it down, but looks like inflation is not going to be that much of a problem this year, although above RBI's comfort zone. So we believe that central bank will not have to raise rates to control inflation. And I think it's true, our rate differential with US has narrowed, but our growth differential has increased. I mean, so they both counter each other. I mean, so I would say the peak is over. When they will cut, our forecast is first quarter of next calendar year, which is January to March quarter, not before that.
Thanks. So we are also seeing another stress that is brewing up in the world's financial system. So over the past 12 years, the global financial system has operated in an ultra low interest rates. Now suddenly things are changing. You see tightening happening over very rapidly in a very short span of time. And that has led to a lot of restructuring and correction. If you look at in the US, the speculative asset prices are getting corrected. You've seen the derivative market and the real estate market. Even FTX, that went into a bankruptcy. Now we are seeing the banks, regional banks also seeing stress there. So my question to you, Shogoto, is do you think this current banking turmoil could lead to a systemic effect on the world, and could the Indian banking system remain immune from that?
So again, very briefly, so this is the, I mean, look, I mean, absolutely no doubt that there will be some other dominoes that will fall. So you're already seeing PacWest, but PacWest is a much smaller bank than the other ones, the SVB and the, so much smaller bank. But I mean, inevitably, I mean, there will be some trouble in the system. To follow up on Shomo's point, you have to credit the RBI for absolutely superb regulation. So I mean, we still might have some problems with the cooperative banks, which is mota the equivalent of the US community banks, the regional banks. But overall, the system is very, very stable. So that's not the point. The point is that one, this is something that will keep on simmering for some time, and there will be a flight of deposits. So the larger banks will become larger. The JPMs of the world will increase their the concentration. The smaller banks will collapse. Problem is in the US. That the smaller banks, these communities banks, they still hold about $4 trillion in assets, $4 trillion in assets. So, and they have an incredible concentration regionally to commercial real estate, a lot of small businesses, etc. So as the lending power, I mean, so inevitably credit standards will be tightened, underwriting, loan giving, etc. will be tightened. So that will impact those small businesses, the commercial real estate. So that probably will have an effect on the US growth. Whenever there's an effect on the US growth, quite apart from anything else, there's likely to be some, what economists call risk off in the system. That means there will be a flight, again, of dollars to safe havens, the dollar, the CHF, etc., the Swiss franc, so all of that, there will be a flight into that. So that will reduce the total amount of funds, the dollar funds in the system, which is the first point of impact in the global financial system, the availability of dollars. The second point, if it becomes a little bit more marked, the second point that becomes a problem is always trade finance. So trade finance, whenever there is large volatility in the global system, trade finance gets shrinks in the system. And that has an impact, serious impact on global trade. Quite apart from the fact that global demand is slowing, etc. On top of that, if trade finance gets hit because of the US. So this is not like the old 2008 global financial system. Banks typically don't hold the kind of kachra that they used to do at that point in time. I mean, so now the problem is essentially bad risk management in these small banks. The kind of risk management that these small banks do is unbelievable. I mean, so some things which are basic 101 banking, they didn't follow. Yeah? So that will inevitably show up. I'm quite sure you will also see that the FDIC and the Federal Reserve will implement some kind of uniform, universal deposit insurance temporarily, because that creates a moral hazard. But these are the ways in which the US banking problems will spill over. It's likely to spill over into the global economy.
Thank you so much. Coming to India, the issue is if there is a contagion, it will be a problem. But what is more worrying is that India needs credit for growth, and it is a precursor for a sustainable growth. So Madan, how can banks ensure that there is a robust credit growth in the economy, and what would be the role of bond market in driving growth in credit?
Yeah, so actually if you look at India and you look at what are the major sources of finance, I think irrespective of whatever has happened over the last 2 decades, finally everybody comes back to the banking system, okay? Because we have spoken a lot about the corporate bond market. In fact, if you see the kind of, if you look at the total issuances in the market, the increase has been fairly remarkable. So you're talking of something like 7 to 8 lakh crores which are being raised every year. But surprising part is that this 7 to 8 lakh crores is actually being raised primarily by the financial sector. So you have your NBFCs who are raising funds out here. Around 70-75% of the funds which are mobilized are by the NBFCs, which are using it for on-lending purposes. So when we say on-lending, it's replicating what the banks are doing. So primarily it will be for the retail people, it will be for the SMEs. We don't really have too much which is going in for industry. And even if it's going to industry, it's more for non-infrastructure based industries. Okay. Now, the issue is that when you look at a corporate bond market, again, it's a very closed market. If you don't have a rating of AAA or a AA, it becomes difficult for a company to raise funds. The reason is simple. The buyers of corporate paper normally tend to be insurance companies, provident funds, pension funds, who would not like to take risk and go in for any kind of what we call junk bonds. So you won't want to go for a lower rated bond. So therefore, we don't have a junk bond market in India. So I think that's one of the limitations. We have been talking about it. There have been committees set up saying we need to open up, but nothing has really happened out there. And obviously, you can't force it. If I'm taking a policy with LIC and I get to know LIC is buying a BB rated bond, I'll be too scared to deal with LIC. So it's a rational process. So I think this evolution of the corporate bond market has been, I mean, we've been talking about it, things are happening, but it's definitely not adequate. The heavy lifting has to be done by the banking system. Now, if you look at the banking system, typically my deposits may be for 3 years. Now, can I lend for 10 years, 15 years? I think ever since we went in for this universal banking concept, I think when the DFIs got converted to commercial banks, they became universal banks. It was felt that commercial banks can do this particular job. Then at some point of time, we had all those lovely scams which came about, no coal scam, telecom scam, that scam and this scam, and then all banks became hesitant to lend for certain industries, for infrastructure. So today we have a happy situation. There's not too much of demand for credit in terms of private investment, low capacity utilization rates, limited sectors which are actually investing. Infrastructure is generally being done by the government. So when we keep talking of government 10 lakh crores of capex, it's essentially, I mean, it's a useful amount, but given the fact that out of 300 lakh crores of GDP, assuming a 30% capital formation rate, 90 lakh crores, 10 divided by 90 is not really adequate. It has to be come from the private sector. So the issue is that, is the system able to create alternative institutions? I think there is this new DFI which is being spoken of, which has been established. I think we need to have more institutions which focus on long-term credit, primarily for infrastructure. I think we have to probably go back to those old IDBI, ICICI, and IFCI days. We have had quite a few experiments, but they haven't really worked because we had IDFC, which finally got converted to a bank. There's IFCL, which was started. I don't know how much is really happening out there. So I think this is a conundrum which we have. And if we are actually talking in terms of getting to the 8% growth path, now, despite the optimism which we are talking of, India being the fastest growing economy, unfortunately, none of us are talking of an 8% growth. We are all happy with 6.5%, 7%. But we did have this 8% growth in the time when there was high doses of investment rate of 34%. Today we're at 28%. Okay, so I think there's been this comfortable situation of absence of demand, so whatever supply was there was looking at it. But to my mind, I think even if you look at the way in which bank credit has grown, how the focus has changed even for public sector banks, there's a shift towards retail credit. I think everybody is following the HDFC model. No, do more retail, fewer what you call NPAs, and your balance sheet looks better. If you do the heavy lifting, go into infrastructure, something will happen at some point of time, and then you will have all kinds of controversies. So I think we need to change this, and I think it's important to have specialized institutions which focus on long-term lending for infrastructure and for investment. And to my mind, this is something which will happen as the system evolves, but as long as we are in this comfortable trap of 6 to 7% growth, investment 28, government doing the heavy lifting, and all of us saying, oh, good, lots of roads and railways are coming, but we need to have other machinery also come up. So I think this is definitely a challenge for us. Banks are playing a major role. At least I've seen the public sector banks are playing a major role out here. But I think for long-term sustenance, we really need to have new institutions come up.
Right. And when we talk about credit, credit to MSMEs actually is quite important because they are the biggest job providers in our country. Now, unfortunately, whenever there is a slowdown or a crisis hits, the MSMEs are the ones which become very vulnerable to credit access because one, they are heavily dependent on working capital and they need cash. And they also have very limited access to short-term financing. The financing options are very limited. And third is if any large company's sales comes down, then what happens is their payments get delayed. They end up with stock inventories because of the cancelled contract. Now, Shomo, I would like to bring you in as in what are banks doing, especially your bank is doing to ensure credit growth in the MSME sector? And there's one more question that I would like to add is that as a women professional, I'm glad to see that women entrepreneurs are growing in this sector. What is your bank doing to encourage this trend and provide credit to women?
Yeah, thank you. Just I will take 30 seconds to give you some numbers because I was listening patiently to all the panelists. So the first thing is that regarding the uncertainty point which I said at the beginning, I think see how this theory of uncertainty macroeconomics has evolved. The Fed was supposed to raise rates to bring down the unemployment, but it is actually coming down. So there is all those Phillips curve discussion has now given way to Beveridge curve, whereby the vacancy is important because labor markets have gone significant changes after the COVID. Skilled people are finding it difficult. Regarding the export data, last year we did 674 billion, 420 billion export of goods, 254 billion services. This year we have done 460 billion exports, 310 billion of services. That is 770 billion. 7 months back, we had said that we will cross 750 billion, and this was vindicated, I think, last month when the minister said that we are touching more than 750. And I'll not be surprised if it touches 1 trillion very soon. I think this is the number. I'm just telling the numbers, nothing else. In terms of the current account deficit, I think our estimates are also the same as 2% last year. This year, which has started, is actually 1.4 or 1.3%. So now let us get these numbers out of the way. Coming to the SME sector, I think the SME sector is one of the sectors, and which is again in terms of the policy. I think I remember after the pandemic happened, there was a lot of writings in the press that Indian banking sector is going to explode. 20 trillion. This is a quoted number which was giving that there will be an NPA. But at that point of time, I remember we had said that this is nothing that is going to happen because banks, Reserve Bank have bought in a financial discipline. Borrowers, they have worked patiently and assiduously, and that is going to hold out. Last year when the report was published, I think the amount of restructured loans after the COVID is not even 1.5 trillion. I think this number is now much less. So that actually talks about the efficacy of the risk management system which the banks have developed after they have gone through an horrid time after 2010. So this is one important point. The second important point is that it was said that the informal sector was devastated during the pandemic. Yes, there was a lot of scarring during the informal sector. Nobody denies that. But it is also need to admit that the bounce back of the informal sector has been stupendous. And we are also surprised to see in our bank book that the stress all of us were expecting were actually much less. I mean, significantly less. Regarding the MSME sector, I think there were some of the schemes which has worked very well, the guarantee scheme. But one important data point which I'd like to, this is a published data, is that I think in India there has been no survey of MSME enterprises. In 2016, a survey was done which said that the total number of MSME enterprises in India is around 6.4 crores, of which 99.94% is micro enterprises. After that, there was no one. Then now what the government has done is basically government has launched an Uddam portal whereby it has allowed that all MSME enterprises should register, and even those, and till date 1.73 crores, if I am correct, has been number of registrations. And the important point to note is that total number of GSTN registration, who pay taxes or doesn't pay returns, GST, is 1.3 crores. So that means, and here lies the beauty, that the government has actually allowed a lot of micro enterprises to also register on this portal through the back end, even though they may not have a proper PAN card. And this was the demand of these people, that you don't have a PAN card, we have small place, please allow us. And that is being done. I would very much like to see how this number 1.7 crore goes up closer to the 6 crore. I don't think it will be as much as that, but the higher it goes, the higher perception it will give that the large number of players who are not registered is actually registering on this portal, and they will getting the benefit of formalization of credit. So this is the most important thing. The other thing is that also we have found in our bank that, which we call commonly the CAG and the CCG business units, basically the large and the medium, we call the corporate credit group, which Sir was leading when he was the MD. And here we are seeing that a lot of MSME enterprises have actually graduated into the CAG CCG group after the turnover changes was done. There was a definitional change in the MSME turnover in 2020. So this is one important aspect, and this is also brought out by a public data which was published by RBI report in Currency and Finance in last 2022, I think August. And regarding, so these are regarding the MSME. So I am very hopeful about the MSME, and this getting bigger means they are getting integrated with the value chain, which we are also already seeing in the PLI scheme. And finally, regarding the women borrowers, it's very heartening to see that in our loan book we have seen that there has been many districts in India now, aspirational districts, where the women home loan borrowers are actually outpacing the men home loan borrowers in terms of taking loan. And the important point is that we all talk about Mudra schemes and other things, but if you look into the experience of the Mudra borrowers and other borrowers, the total number of borrowers over this is around 70%, and any government scheme today you find out, you will find that the women are actually taking the lead. There is one scheme which the government is running, which is a very important scheme. The impact will be done only felt 2 to 3 years. That is the Sanvita scheme, wherever it is giving out property rights to 6 lakh villages across India. There we are finding that because of giving out these property rights, there are been women who are actually been able to borrow from the market. And these are the districts which is called the aspirational districts. And this we had written in a report recently based on some of the data which we had gathered. But my sense is that yes, women are taking the lead. Incremental deposits of women in rural areas in 2022 March was 66%. That means for every 100 rupees mobilized, 66 rupees came from the woman, and that has been also because of the many schemes the government is running, and also because of the changes in the cooperative bank ruling which they have done. So we can go on discussing these changes, but my sense is that I think these are some of the subtle changes which are happening in the economy, which we need to take notice of at the end of the day. Because we had made some estimate also, the contribution of the unpaid women workers to GDP is at least 7%, which is not measured in true terms.
That's wonderful. Yeah, sure.
Just a quick point. I think one of the biggest challenges for the SMEs today is that when they borrow from banks, they have the external benchmark, the EBLR. So that's a challenge, because what happens is when repo went up from 4 to 6.5, automatically my cost also went up by 250 basis points. Whereas for corporates, you go on the basis of MCLR, which is a bit stickier than the EBLR. So I think this is a challenge which SMEs also have.
That is a good point, and because of that also what is happening, the registration could have been even higher. A lot of SME are saying कि हम क्यों करें क्योंकि हमको तो rate of interest we have to be MCL, that link. So basically that is also one of the link because of this EBLR mechanism.
That's not completely, because a large part of MSME financing is now also coming in from NBFCs. Banks are on lending to NBFCs, who are then lending on to SMEs who are not covered under the EBR scheme. By the way, I'm very, very confident about the MSME segment because of this data. You'll hear in the next panel from my colleague and his colleagues, this technology now, driven by the deluge of data, the zettabytes of data that are now coming in, is making risk analytics so much more easier with the MSMEs. So I'm very, very confident that MSMEs, lending to MSMEs, will have a very bright future.
In fact, since I think I'm here in Sabathana and rebuttal mode, it's confident of SMEs, but what I've seen is that when we have been doing our corporate studies, what we have seen is that the SMEs are actually, they're seeing the profits, they're making losses. The larger companies are the ones who are actually driving the overall corporate performance. So this is just based on data, balance sheets. Of course, most of the SMEs don't have balance sheets. Accounts, but whatever is available on standard corporate databases, we have seen that the SMEs have been affected more than the larger companies. So that's why I'm not too gung-ho, because you see they are generally constrained. Everybody talks of SMEs. And even when you're talking of exports, 40% of our exports come from SMEs. And when we say exports are going to be under pressure because of a global slowdown, this also means that SMEs are going to be under pressure. So I think they're the ones who need more attention, and you still require more handholding.
Thank you so much. So I guess we understand there's a lot of enthusiasm about MSME's growth in here. We would like to have some questions.
All the economists are sitting and we are talking about the harnessing banking and that is driving growth. I would like your views on this ECL, estimated credit loss guideline, which is not yet finalized fully by RBI. How much impact it is going to make on the capital adequacy of the banks, and how are they going to flow the growth in the country? It's a very, very important debatable point which has not been touched upon, but I thought the wisdom of the so many economists sitting here, you must have studied the bank balance sheets and credit book. So how are they going to meet this growth of 10-12%, some banks, and 14-15% the other banks? The growth with this ECL mechanism coming into in the next year? This
No,
year?
unfortunately, I cannot comment on it. I'm an economist, not a banker. I think Mr. Basu, I'll throw the question on you. I think you're the right person. Soumya, of course, I'm not speaking for others, but.
Yeah, we'll discuss it. It will come up in the bank
Yeah. Okay, why don't you take the question, next question? Yes.
Thanks. I think 1 hour is too little for this very engaging discussion. But I have just two quick questions. You can answer any one if you like. One is, what does India need to do to rejig the capital investments by private sector? Because you have 10 lakh crores from government, 2 lakh and 1.5, almost 13, 14 lakh crores coming on capex, but is not happening enough on the private sector. There is some upbeat, but that's one. And number two, Mr. Joshi, you talked about PLI. So how much of these exports is going to come from the 2 lakh crores allocated to PLI over the next 3 to 5 years? Thank you.
Yeah, I think on the PLI, I don't have an estimate of exports, but yeah, the electronics exports through PLI is on a rising trend. And of the total manufacturing output, I think about 15% contribution will come from PLI. So PLI is not, what it is doing is, it's not something new that is adding up. It is accelerating the pace of private investment. What would not have happened in an uncertain environment is happening because you have incentives. I think that's so. Some new investments are coming, some of the investments are getting fast forwarded. So that is why I think, so everything that is under PLI is not that, it would have happened anyway, I mean in some parts. But this is acceleration, so what we will see is that the share of PLI in manufacturing production will be around 15%. And this scheme will end at around, I think 26 or so. Maybe we'll have something else after that for the ecosystem that needs to be created. I mean, if you are pushing mobile phone assembly, etc., you will also need incentive for creating an ecosystem at some point in time. Otherwise, this is just screwdriver technology. Yeah, I think for the others, you want to.
See, in the terms of what drives investment, to my mind, the problem in India today is demand. Demand is because there's low income because they're not creating jobs. So irrespective of whether we go to CMI data which says high unemployment rate, EPFO which says jobs are being created, at the end of the day, I need to have spending. Creating jobs like Swiggy delivery boys is not going to create, having construction workers is not going to generate my income. We need manufacturing to actually provide the boost. Manufacturing provides the kind of jobs which can create the income, which will help to create the demand. Once the demand comes in, capacity utilization improves. Once capacity utilization improves, we'll see fresh investment. Today, you're an industrialist, I am not. If you don't see demand, there's no reason why you should be investing money. And if you have not seen it happening even in the pre-pandemic times. Because if you go back to saying when our investments slacked, our capacity utilization rates came down, this is of course at a general level. There are certain sectors linked to infrastructure which are of course investing. So there where you see demand, those industries are also generating jobs. A quick statistic, we do regular studies on employment based on annual reports of companies. Now this is based on published headcount on March 31st. When GDP growth used to be around 8%, we had employment headcount going up by 6%. Pandemic, it was negative. Today, it's around 2%. So quite clearly, I think jobs need to be created. And today, I think we all talk of export of services, IT industry. Every day I pick up the paper, somebody or the other is sacking people. And today we talk of lots of AI, ML, what does that mean? Finally, you'll require 4 robots to sit here and tell you exactly what we're taking. We ourselves may not be required on this forum. Yeah? So I think we are self-destructing also to a very large extent. Maybe even the audience, you all won't be required. There will be some dummies sitting here and asking questions. One never knows. No, on a serious note, I'm saying we need to create jobs. That's the crux of it.
Thank you.
To your specific question on the ECL, I think you must be referring to a report which was published. I think a lot of these reports actually, without making hay while the sun shines, but we have done a study on that one. I'm not getting into details of that, but one thing I can tell you is that it's actually a progressive regulation in the sense that if you have more data, then actually your capital requirement of the bank will be coming over time if you can make use of the data more effectively. Because we have because in USA also, in India we have a provisioning approach which is 15, 20, 40, 100 over a period of 4 years. But without taking into impact of collateral, I think this we have been highlighted several times about the value of the collateral. But the basic issue is that I think this is a good one Of course, it could have some impact on the capital for the lower rated banks, but it's a progressive one because this actually will help in optimization of the capital requirement of a bank depending on the specific data which has been provided. And I think banks are already very proactive in identifying risks, and it will make them risk management even better, for example, in a bank like us.
Thank you.
My point was that how will they drive the growth, because their capacity to give the credit will be reduced over a period of
Capital
next
will not be impacted that much. That's the point which I want to say.
Thank you so much. We are already over the time, so let's wrap up. Thank you so much for coming here and for the wonderful stay. I hope you enjoyed it. Thanks again.
Thank you for that interesting session, panelists. May I now request Ms. Rumki Mazumdar to present a memento to Sri Dharmakirti Joshi as a token of her appreciation and gratitude. May I request Ms. Rumki Mazumdar to present a memento to Sri Madan Sabnavis as a token of her appreciation and gratitude. May I request Ms. Rumki Mazumdar to present a memento to Sri Shogata Bhattacharya as a token of her appreciation and gratitude. May I request Rumki Mazumdar again to present a memento to Dr. Shaumya Kanti Ghosh as a token of her appreciation and gratitude. May I now request Mr. Anand Singhania, President IMC, to present a memento to Ms. Rumki Mazumdar, the moderator, as a token of her appreciation and gratitude for having conducted such a wonderful panel.